there's so many ways that people can take advantage of being able to have cash and using leverage and not being afraid of borrowing.
You're 100% right. When you borrow, doesn't mean you're in need of money. That's why you're borrowing. It just means leverage. Like you'd rather use your capital another way. If you look at, who borrows the most money from banks and lenders, it's, family offices, private equity firms, hedge funds. These are the biggest buyers of debt. They don't need money, right? They have a lot of money, but they're going out of their way and getting leverage from banks and mortgages and all types of lenders because of leverage. They're parking money in other assets that are gaining momentum. They're gaining value every day. They're growing, and then they're paying interest, and the interest they're paying is they hope that it's less than the growth of their assets. So they're making money on top of money.
Welcome to the Uncensored Real Estate Podcast, where nothing is off limits. If you're interested in buying, selling, or investing in real estate, and you want to learn some of the insider secrets and uncensored truths from the true professionals in and around real estate, you've come to the right place. Now, let's buckle up for the uncensored truth about real estate and join your host, Brian Cardenas.
All right, everybody, welcome to the next episode of the Uncensored Real Estate Podcast, where nothing is off limits. If you guys are catching us on YouTube today, would love it if you would hit that subscribe button and also the notifications bell so that you get notified when we drop another episode. And if you are checking us out on your favorite podcast platform, which is any of them, we would love it if you would give us a great review and share this episode with your friends, family, whoever you think can benefit from the information that we are sharing today. And we're going to go kind of real estate tangent today, talk about some finance stuff that I think a lot of people may not know about, not know that they can take advantage of. And so we wanted to bring in an expert in that area, and that is Sarry Ibrahim. He has his brand is Thinking Like a Bank, and website thinkinglikeabank.com. Sarry, thanks for joining us here today.
Hey, Brian, thank you so much for having me on. I appreciate it.
Yeah, absolutely. So let's kind of just start out real quick here. Give us a little bit about your background, kind of where you came from, and then how did you get to the point where you're at today, and why did you get to this place in your business?
Yeah, absolutely. So I'm from Chicago, Illinois, born and raised here. I started off in the financial services industry about 8 years ago. Pretty much when I was about doing my MBA program, halfway through my MBA program, I started working at Allstate Insurance and a couple other insurance companies. I started my own business about a year after that, and mostly specialized in like Medicare and retiree products for retirees. So a lot of people who worked for the city of Chicago, they were retiring, they needed help with that transition. So I helped with that. And then I found out about the bank on yourself concept. It's a concept trademarked by Pamela Yellen. And really the introduction of the whole concept started off in her book, The Bank on Yourself Revolution. So that book really changed the way that I started dealing with clients and the ideas that I would share with clients. So we could talk a little bit more about what that strategy is later on. But after I found out about the Bank on Yourself concept, I joined the Bank on Yourself organization, became a Bank on Yourself professional, started a company called Financial Asset Protection. And that's our we're a financial services firm. And our primary tool that we help clients with is the Bank on Yourself concept. And then that also led, because as you could probably tell by the title of the Bank on Yourself topic, it has a lot to do with banking principles. And then that led us to starting our own podcast called Thinking Like a Bank podcast. So that's where we're at today, and glad to talk about Bank on Yourself as well as other financial strategies for real estate investors.
Yeah, I think let's start there. Let's start on banking yourself, because I think what I see with people, just the average consumer, and I'm hoping that maybe people got a little bit more of an insight to how banks work with the recent banking crisis that we went through. But I think most people don't understand how things work with banks. They just look for a place where they can park their money. They may not necessarily be thinking too much about what are they making or losing by having money there, and they're just looking for a place to go use their debit card, use their credit card, get a car loan, things like that. Mm-hmm. And that's really not what banks are all about necessarily. So I'd love it if you can kind of give us a little bit of insight about how banks work, and then the Bank on Yourself program too.
Yeah, definitely. So I think most people think that when you, for example, go to the bank, deposit $1,000, that they have a vault there and they're putting $1,000 in that vault. And then when you want it back, you go back there and they take out that very same $1,000 and they give it back to you. That's not how it works, right? It's
Right.
called fractional reserve banking, and then in short, fractional reserve banking gives banks the ability to loan beyond their deposit, probably 10 times their deposit. So if you put $1,000 in a bank, for example, they could probably loan out about 10 times that in the form of various investments, right? Car loans, mortgages, personal loans, lines of credit, all types of different loan vehicles. So that's essentially what's happening with banks, and we saw that in Silicon Valley Bank. Their investments went down, so they borrowed money, raised money, their investments went south, and then at the same time the stocks plummeted, which then alerted the depositors, and then the whole pyramid kind of collapsed in, because it's kind of built, the whole fractional reserve banking system is kind of built on hope. Like, you're hoping the depositors keep their money there, they keep depositing more money, and then you're hoping that the people who borrow money from you, the customers on the other side of the equation, keep paying the loans. And really, it's just it's a matter of time until the whole pyramid collapses, and it happened twice already in a couple of different banks. So it just shows that it's not really that stable of a system. And then the FDIC insurance, I think we actually just did a podcast episode about this on our podcast. FDIC insurance really doesn't mean much, because there's, like, I think over probably $20 trillion right now in deposits across the country, and the insurance is, like, up to a trillion at this point. So imagine if everyone took out their money, if banks collapse, there wouldn't be enough money it would be impossible, mathematically impossible to reimburse everyone, even if you're below the FDIC insured amount of 250,000, I believe. So even if you are under that amount, it's practically impossible. If banks lose and the FDIC insurance loses all its money, they'd have to print more money. They'd have to tap into other, federal and reserves and other types of things like that to be able to reimburse people. So it's a very volatile program. The fractional reserve banking system is a very volatile system. And then Bank on Yourself actually talks about how you could avoid all of that. You could park your money safely. It has to do with whole life insurance. Now, before I lose the crowd, I'm not talking about whole life insurance where it's just, death benefit only. There's also a cash value component to it. And the cash value component is where you could store cash into it. You could borrow against it. You could use it for financing. You could use it alongside other types of financing. So that's what the Bank on Yourself strategy is. It's using dividend paying whole life insurance for cash growth purposes.
Yeah, and it's a concept I think a lot of people don't really understand, if they know about it at all. And being used to the banking system that we've all participated in, I think people got their eyes opened up a little bit, recently with this, if you pension at all. And just kind of like what you were saying with the banks is, if you give them $1, they're going to lend out most of that dollar, like probably 90 cents of that dollar, so that they can go make money off of the money that you gave them. And if they make a 5% return and they're going to pay you 1%, they're making that delta, that 4% difference. That's how the banks make their money. And in that whole system, I think people probably came to the realization that the problem that they had is that they were lending out a lot of times in mortgages, mortgage-backed securities, and treasuries that were making 2% return. And then all of a sudden interest rates get jacked up to on short-term rates fives, fours, fives, and then all of a sudden somebody gets wind of it and says, hey, I want to pull my money out because you're paying me 0.25%, and I can go park it somewhere else and make 4%, 5%. Well, those aren't necessarily that liquid, the investments that they have. And so now if somebody's going to go buy that mortgage-backed security that's yielding 2% or 3% or whatever the number happened to be, they're not going to give all of the money that they paid for that investment. If it was a $10 million investment, but it's only yielding 2%, they're not going to pay $10 million for it. Now they're going to pay something less. So those losses start to add up and add up and add up. And that's where the whole system started to fall apart. And so with moving to something like a product you're talking about, to put money into a whole life insurance policy, most people's, I think, primary concern would be, well, how liquid is that? And, can it operate like a bank account? Am I going to have that much access to it? Or am I going to have to, still involve a bank in the whole process?
Yeah, absolutely. It is a liquid investment. So the way it works is you fund the policy, right? You buy a certain amount of life insurance, and with that comes cash value in the policy, and then you could borrow against it. One of the companies we work with has we have an online portal. You can log into the online portal. You can see what the cash value is. You could request a loan. So that's kind of how it works. When you take money out of it, usually you could withdraw money out of it. When you withdraw money out of it, it kind of defeats the whole purpose of this. You want to borrow against the policy. And the reason why is like, so some clients are like, especially like Dave Ramsey, he's like this whole, he doesn't believe in whole life insurance. If you've seen his content before, he says, wait a minute, you're going to buy a whole life policy, you're going to put money into it, and then you're going to borrow your own money. Why on earth would you do that? And there's a reason for that. So the reason for that is, let's just say you were going to buy a car now, right? And then you were going to finance it. Well, if you finance a car, then you pay interest to the lender. That's scenario one. Scenario two is you want to avoid interest, so you just pay cash for the car. Well, you paid no interest, but you also gain no interest on your money. Your money was spent on the car. So that's the second problem or scenario. And the third is, well, we'll have some sort of account that earns interest, and then we'll borrow against this account that earns interest, but we'll pay less in interest to borrow against the account than we are paying. We'll pay less than we're earning. So in the third scenario, we pay interest and we earn interest, but the interest we earned was greater than the interest we paid. That's also known as interest arbitrage. It's where you're making money with just the spread, just exactly how banks do. So that's the purpose of using a whole life policy, is because your policy earns compound interest. And then when you want to borrow against the policy, you borrow at a lower interest rate. Your policy keeps compounding, keeps growing, as whether you take out a loan or not, your policy keeps growing. So you take out this loan, you pay interest on that loan, but the interest you pay is less than the interest you earn. So your policy comes out ahead. So that's why you would borrow against a policy.
So just use some examples to make it make sense for people. If you're, let's say you're earning, I'm going to throw it a number out, say you're earning 7% growth on your cash value. Approximately what would that cost? And then is the money that is collateralizing that loan, is that taken out of that same investment fund? Does that decrease the rate of return that they get while you're borrowing against it?
Okay, I'll answer the second one first. So when you take out a loan, it does not affect the growth of your policy. In other words, when we project the cash value of the policy and the life insurance, you have like a guaranteed column which says like no matter what happens, you get the this amount of cash value over time and this amount of death benefit over time. And then there's also the non-guaranteed side. The non-guaranteed side is the same as the guaranteed plus dividends from the insurance company. So we go with the non-guaranteed side always because of the track record of the insurance companies we work with. So on the non-guaranteed side, you have your outlay, like how much you're going to project to make. And then whether you take out a loan or not, it does not impact that non-guaranteed outlay with the insurance companies we work with. Some insurance companies will there's almost like a penalty for taking out a loan. Not really a penalty. They just reduce the interest and dividends they're crediting your account when you have an outstanding loan to stop you or to deter you from taking out a policy loan. But the insurance companies we work with, whether you take out a loan or not, it does not affect that future projection of your cash value or life insurance. So that's the first part. And then the other part is if you took out, so it's not going to be, just to be transparent, it's not going to be 7% growth. It's probably going to be closer to 4.5%, 5% growth over the long run in the policy. So it's not really like, you're not going to triple your money in a year with these policies. It's a very conservative rate of return. It's really meant to replace savings accounts and other similar types of liquid investments. So that's the thing. So you're probably going to earn around 4.5%. And then when you borrow, if you took out a loan and paid it back in 4 years under current interest rates, it would come out to about 2% APR in the policy. So it's a little bit confusing, but I know you're in this industry, but it's a little bit confusing for other people when I explain it this way.
You gotta keep it simple.
It's a 5% simple interest broken down daily. So if you took out $100,000 loan, it's today's interest rates 5%. You take 5,000, you divide that by 365 days. Your loan balance grows by whatever that amount is. I think it's $1.14 a day or something like that. It grows by that, probably more than that. I think it's like $5 or $6 a day. It grows by that amount every day. Until the end of the year where it equals 5,000. If you don't pay that at all, and then it gets compounded into the next year. But if you did pay monthly payments on the loan, it would come out to about 2% APR over a 4-year period. So you will have we've done the math. Like for sure, we could prove the arbitrage where here's a policy, here's a growing, here's a loan, you pay back the loan, the interest you would have earned in the policy would be greater than the interest you would have paid.
Gotcha. Yeah, and that's important because when people are looking at borrowing money, there's a fear that gets instilled in us, whether it's from parents or grandparents or Dave Ramsey, like, don't pay interest. And it's really not something that people should fear, because there is some power in borrowing. And we talk about it in real estate investment all the time, and you're talking about it in a similar fashion, not exactly the same, but yeah, you're borrowing, yes, you're paying interest, but if paying that interest allows you to continue to earn more money on that cash amount that you decided not to pay cash for. Same thing like you talked about buying a car. You can pay $50,000 to buy a car, but if you can keep the $50,000 earning you a higher rate of return and pay some less for that, well, then you're actually making a little bit of money instead of losing all that interest growth that you gave up by paying cash. Same thing with real estate. I see people all the time where, they've got, a big pile of cash. Maybe they sold a property, they're downsizing, and they say, okay, I want to go buy a house, and I want to pay cash for it. Realtors love it because that makes it simple. It makes it a more attractive offer. They don't have to involve, people like myself, mortgage people in getting the financing done, but they're missing out on the power of leveraging by borrowing a portion of that purchase price, putting down some amount of money, but then borrowing the rest of it. I know interest rates are higher today, but generally, relatively low rates of interest when you're borrowing on a mortgage, for example. And the rest of that cash, you can either go and keep that in an investment if you have another investment that you were getting good rates of return, or you can go buy 3 properties or 4 properties instead of just buying one. And now your gains on the growth, and you've got renters paying the mortgage. Like, there's so many ways that people can take advantage of being able to have cash and using leverage and not being afraid of borrowing.
You're 100% right. When you borrow, doesn't mean you're in need of money. That's why you're borrowing. It just means leverage. Like, you'd rather use your capital another way. If you look at, who borrows the most money from banks and lenders, it's, family offices, private equity firms, hedge funds. These are the biggest buyers of debt. They don't need money, right? They have a lot of money, but they're going out of their way and getting leverage from banks and mortgages and all types of lenders because of leverage. They're parking money in other assets that are gaining momentum. They're gaining value every day. They're growing, and then they're paying interest, and the interest they're paying is they hope that it's less than the growth of their assets. So they're making money on top of money. They're it's a powerful strategy. I think a lot more people should use it. And you're right, because I think when people hear debt, they hear interest, they automatically think like, that's bad. We need to get away from interest. We need to get out of debt. And to a certain point, it does make sense, right? Like, if you had 5 credit cards and each one was 25% APR interest, and 50% of your salary is going to servicing debt, yeah, that's a problem you need to address as soon as possible. That should be at the top of your list to get rid of all that debt. But with mortgages and lines of credit and life insurance loans, these will help amplify your net worth and help amplify your cash flow.
I think that the phrase that we always tell people is there's good debt and there's bad debt.
Yeah.
And definitely, like you're talking about, when you've got credit card debt, that's bad debt for the most part, because your interest rates are really high on those, and you're going to have a tough time being able to earn a higher rate of return than 20% interest or 29% interest on a credit card. So that's the bad debt. That's the stuff you should be afraid of. That's the stuff you should pay down as quickly as possible. But the good debt, usually, it's usually secured by an asset, not always, but a reasonable rate of return where you can take and use that money and make more than what you're paying for it. I mean, that's the concept that so many businesses use, like you said. Banks, hedge funds, family offices, real estate investors, and you're spot on with that the biggest borrowers of money in the world are the richest people in the world.
Yeah.
People want to criticize, people with a lot of money that, they're not paying taxes. Well, there's lots of tax strategies you can take advantage of, and a lot of them involve borrowing money, because the tax system is set up that if you're borrowing money and you're paying interest in a lot of different ways, you're going to be able to write off that interest from your taxes.
Right.
So it's just smart strategies. There's a big difference there in taking advantage of things that are on the books for us.
Absolutely. Yeah, definitely.
You want to buy a house, but high interest rates have got you down? Take the rate challenge and send us a verifiable loan estimate from another lender, and we'll beat it and pay for your appraisal up to $600. Here at Give Mortgage, being powered by U Mortgage allows us to provide you with unmatched speed and efficiency and the best rates and fees in the market, all while delivering you the concierge level service you deserve. We want you to have an experience getting a mortgage that you'll never forget, and not because you got put through a meat grinder to get it. At Give Mortgage, we give great advice, we give the best rates, and we give back to charity. Visit us at www.give-mortgage.com or call us at 480-331-4684 to schedule a free consultation to see how we can help.
So tell me, a lot of people, they go to work for a company, they'll get a 401k, and they'll use that 401k, and they think that that's the best type of investment that they can make. And not to downplay, 401ks can be really good. What are some of the maybe the downsides of a 401k, and then obviously the plus sides of a 401k?
Yeah, absolutely. So I think if you compared a 401k to not saving at all, I think the 401k would win, right? Like I promote 401ks, and I urge you, if you have a company 401k, use it. Even if you don't have a match, it's better to put money away, even if it's a stock market. I'm not, entirely pro stock market, but even if that means not saving money at all, then put it in the stock market, put it in a 401k, because it's better. It's good to have that forward saving behavior, for those habits that you're going to build. That's good. That's going to help you in your future. But I think there's alternatives, right? Like you look at alternative investments. There are alternative things you could do out there. For example, one of them, let's just say you worked at a company, you've built up, 200, 300, 400,000 in a 401k. You left the company, you have this old 401k now somewhere with Fidelity or TD Ameritrade or whichever custodian it was with. And then now you're thinking, well, what should I do with that money? Should I just keep it in the stock market? And then you keep opening your account, and it's like plus or minus up every day, like 10,000, 20,000 up and down. You're like, maybe I could do something better with this. And you could, right? You could self-direct that. You can roll it from a 401k into a self-directed IRA. You do a tax-free rollover from one qualified account to another qualified account. And then you take the money in the self-directed, and you can invest in anything except for a couple of things. I think you can't invest in life insurance and precious metals. I think a couple other things you can, or collectible coins. Sorry, you can't invest in collectible coins. So you can invest in essentially anything else. You can find a private placement, real estate syndication, and do your homework. Talk to your accountant about this. Talk to a financial advisor. Don't just listen to me and just jump on this. But there are private placement investments out there, like real estate syndications. If you're an accredited investor, you could do far more. Even if you're not accredited, there's certain things you could do, but there's a little bit more. They're a little bit harder to find. So syndications for non-accredited investors. But then you find a deal. There are some deals where they're only 2-year holding periods. Some are 3 to 5. Some it's for as long as possible. The general partner will hold the deals as long as possible. So there are private deals you could do. And then the projected rate of returns on these are pretty high, right? These are, I would say, higher risk, higher return investments, north of 15, 30, 35% internal rate of return on these. I think far more that you can get in the stock market. Again, these are illiquid investments too. So if you put money into these properties, you probably can't sell out in like a month or 2 months. You could if you did in stocks and bonds and mutual funds, but you can't when you have this money in real estate. It's considered an illiquid investment. So it's just something I want to kind of plant some seeds, right? Like think about it, look at some other ways of investing. You could use the bank on yourself strategy that I just talked about earlier. You could use that to invest in real estate deals as a limited partner, or you could use your IRA. And there's pros and cons on both sides, right? I think the point here is there's more to investing and saving than just 401k, Wall Street, stock market, no debt. There are more things beyond that.
Yeah, I think that's a really important point to make, because the scope of what people know is out there and available to them as investment options tends to be relatively limited. You hear about an IRA, you hear about 401k, you hear about stocks and mutual funds, and that's kind of like where a lot of people, the general public, is putting their money. And they're probably not digging into it a lot of times to see what kind of fees are being charged and all that. And like, what is your money actually doing? I mean, you watch it maybe on your monthly statement, or you go into your portal and you see it, and in the last year it wasn't very pretty. and people were just, seeing lots of things go south on them. And I think people maybe started, looking around and looking for different things. And so to your point, there's investments that you can do that provide liquidity, because you have to have a certain amount of liquidity. You have emergencies, things like that. Those are going to get you lower rates of return, but they're safer for that reason. You have access to the money. But like you mentioned with, on the other end spectrum, real estate syndications, like you said, those can be 3 to 5 years a lot of times. And I think that's one thing that people don't really know, that's a possibility, because being an accredited investor, you may not dug into it, but a lot of people don't know what it means to be an accredited investor. They just hear this term and they go, oh, that's not me. I'm pretty conservative. But touch on what the qualifications are to be an accredited investor.
Yeah, so the easiest one, you have a net worth of $1 million, excluding your home. The second one is if you're single. I think based on last year, I don't know if they changed it. It was 200,000 in annual income if you were single, and then 300,000 if you're married, filing jointly over the last 2 years. So there's an income requirement, 200,000 single or 300,000 married, and then there's a net worth one, or so you could 1 million net worth excluding your home. And then there's another one too. If you are a registered investment advisor, like you have your Series 65 license, you're a certified financial planner, chartered financial analyst, a couple other ones. If you can qualify as a registered investment advisor, then that also makes you accredited.
And really what the accredited investor thing is about, it's to make sure that you have the financial savviness to make sure that you dig in and understand the investments that you're getting into. That's really, I don't know if they ever thought about making you take a test or something like that, but they're figuring if you make $200,000 or $300,000, if you've accumulated $1 million in net worth, you've done enough right to have financial savviness about you to where you can properly analyze these types of investments. The other thing that people can do is, like you mentioned, is if you've got a bunch of money sitting in a 401k and you've left it there, or you've put it into just a regular IRA, switching over to that self-directed IRA, that's something that you can use to invest in real estate investments, right?
Right, exactly. You could do, I mean, that was just one example. You could do really anything. You could invest in all types. So you can self-direct. Let's just say you have a friend that owns a business and they're looking to raise capital. You could use your self-directed IRA to buy shares of their business through your IRA. You could loan money to them through your IRA. There's some restrictions, of course, like the passive activity versus passive activity rules. Like, for instance, you can't invest in your friend's business with an IRA and then like be actively engaged in the business, or real estate even. Like, you can't buy real estate, you can't buy property in your IRA and then actively work on the property, like talk to contractors, talk to tenants. Like, it has to be entirely passive. You'd have to hire a property management company. Everything has to go through them. You can't be engaged actively in the investments in IRA. So there's some things, and if the government finds out, the IRS finds out, then they'll treat whatever investments you were doing as early withdrawals. So if you invested 200,000 in real estate, you were actively involved, it would be 200,000 as ordinary income for that year, plus a penalty if you're under 59.5. So it's very serious stuff, right? Like, make sure you're doing the stuff with your accountant's advice, your attorney's advice, financial advisor's advice. But yeah, you could do essentially anything except for the couple things. I think collectible coins and life insurance are one of the fewest things you can't do in an IRA.
Yeah, and I mean, it's definitely something you want to have the right advice in there. You don't want to mess with the IRS because they have some, not that they're going to do it all the time, but they have some crazy powers to do things that you don't want them to do, like dipping into your accounts and different things like that. So that's definitely something to watch out for. I think one thing that a good rule of thumb that people can kind of think of when it comes to that is, you kind of mentioned it, is if the IRA, when you're doing a self-directed thing, you really have to have no connection to it. That's why, like, if you move money from a 401k over to any IRA, whether it's self-directed or otherwise, it can't go to you. You can't collect that money and then go place it. And so the same thing goes if you're doing a self-directed IRA and you're investing in a real estate investment, it's going from your IRA to that other entity that you don't have a connection to actively being involved in. There's got to be that separation there. So if you feel like there's any possible way where you're actively involved and there's not a separation there, you probably have a problem there.
Right. True.
So what is a really common mistake that you see people making in their finances when they're coming up to retirement? They're not quite there yet, but maybe they're 5-10 years away from retirement. What is something that you see as a common mistake that people are making, whether it's planning or investing, whatever it might be, something you can kind of help people prevent themselves from doing as they're getting closer to retirement age?
Yeah, good question. So I think volatility is one of them, and I think volatility is like it's misunderstood. So what I mean by volatility is like the movements in the markets, right? So like if you had 500,000 now in the stock market, it drops 20%. Most people would think, well, if I get a 20% gain, then I break even, right? And then you look at like the rules of math. That's not true. Like typically it's double that to break even. So if you had a 20% drop, you'd probably need close to 40% in gains just to break even. So I think the volatility aspect should be taken more seriously. Wall Street and a lot of advisors who specialize in stocks would say like, ups and downs, you come out ahead. And that's not always true. Like sometimes you don't come out ahead. Sometimes you end up with less than what you started with. You're less than your basis even. You took a loss on that. You just didn't feel the loss because it was over like a 15, 20-year period and it involved you putting money in and things like that. So that's one thing, the volatility aspect is you don't want to lose money. If you're 5-10 years away from retirement, you want it to be to the point where you take your money that you have now and it grows no matter what. That's the kind of like the first thing is the volatility aspect. And there are ways you could do so. We're talking about safe investments, high, not high interest, 3, 4, 5% interest rate investments. That I think is better to have that grow compound over a 10-year period than taking on more risk. So that's the thing. And the other thing is the planning aspect. I think the life insurance conversation, even though I started off this podcast episode talking about the cash value benefits of life insurance, I still think that there's the death benefit of it, the life insurance aspect of life insurance policy. And a lot of people don't think, nobody wants to think about that, right? But if you're heading towards retirement, you need to think, all right, what if I pass away in the next 20 or 30 years? And then it goes into the estate planning conversation. So if you had, the estate plan right now, the estate limitation is like 13 million. So if you have assets under 13 million, you don't need to really plan on the tax part of your estate plan. But if you did, let's just say you had, $50 million in real estate and you passed away, right? So now what happens is because you're above that limit, the $13 million limit, a lot of your real estate assets and the estate is going to be exposed to estate taxes. Estate taxes are 40% beyond the last bracket. After $1 million, it's 40% of that in tax. So it's a very high tax rate on the estate plan side. And if you have a whole bunch of illiquid investments like real estate, then your family, your beneficiaries are going to have to sell that real estate. And I think there's never really a good time to forcefully sell real estate. If the market is high, it's bad because you're taking a loss. If the market is low, you're taking a loss. So really, when you sell real estate, when you don't have to, it's not a good situation. So you can avoid that through life insurance, right? You allocate a certain amount towards premiums over the next 10, 15 years. You pay up the life insurance. So it's paid up. It doesn't require any more premiums and it keeps growing. And then, 30 years from now, when you pass, age 90, age 95, age 100, you pass away, your family gets all that cash, all that appreciated cash from life insurance, and they could use that money to pay your estate taxes and keep all of the other illiquid investments, the businesses, the closely held corporations, the real estate, all of that stays with the family. They just use essentially they use life insurance to pay all the taxes and administrative expenses.
Yeah, I think that's something that people don't think about a lot is that, there's going to be expenses for things. I mean, you may have real estate investments and, you pass it on to your heirs and that may not be their thing. They may not want it. There might be some things that they need to liquidate things for. And, oftentimes there's taxes. If you haven't done proper planning with your real estate, one of the things we talk about sometimes is doing 1031 exchanges. Mm-hmm. Well, 1031 exchanges where you sell an investment property, and again, similar to the IRA, is that money flows through an intermediary and then goes into the next property or two or however. When you continue to build that up, you defer paying those capital gains taxes so that you have more money net out of the sale proceeds to go to the next investment. And, one of the really big benefits to structuring things that way is when you do die, you get the advantage of that stepped up basis, so that now the heirs inherit it without a big capital gains bill
Yeah.
that's going to come due to them. They're basically starting fresh. You might have bought it at $100,000. It's $1 million when you pass it on. Well, now they're inheriting it at a basis of $1 million. So they're not going to have a big tax bill. But if you didn't plan properly and didn't take advantage of that, they're not going to get the advantage of that. And that's where the life insurance comes into play. And it's really advantageous for people to think about that a lot earlier in life, not when they're 60 and then trying to figure things out, because the life insurance is going to be more expensive when you're 60 compared to what it might have been when you were 30 or 5 or 40.
Yeah, absolutely. That's so true. I think a lot of people might think that term is cheaper than whole life, and I could prove it through illustrations that term is cheaper. Obviously, if you're 30 years old, if you're comparing term to whole life, term is going to be much cheaper. But when whole life could be paid up. You could pay it up for your whole life. Term can never be paid up. You always have to keep putting premiums in. And typically the way term works is there's either a 10-year, 20-year, 30-year, some sort of variation between those numbers, a term period. Well, let's just say you do a 30-year, right? You're 40 years old, you do a 30-year term. At age 70, now, depending on the insurance company, you might have to go through underwriting again and renew, or it's just automatically going to renew. But when you go into that year 30 to year 31, it's going to probably be 10 to 15 times more expensive. So if it was $1,000 a year, during the 30-year period, it's probably $10,000 to $15,000 now in year 31, and then it might even have an annual renewable term. So every single year, it's going to go up, and eventually, 99% of people end up canceling it. They either cancel it or they convert it to a whole life because it gets too expensive. Like most people can't handle that much pain, right? To pay $10,000 this year, then $12,000 next year, then $14,000 next year after that in term life insurance. That could be avoided. You could do the 30-year term, but then convert it into a whole life, and then you could pay up the whole life. You could do a 7-year pay. You pay into it for only 7 years. That's it. It's paid up for life. It appreciates for life. It's paid up. Or 10-year or 15. Obviously, the more money you add into it, the more money that can grow in the later years. So I would say the advice from here is not so much about the life insurance part, but it's about don't just take things at face value. Like, if you're watching CNBC or Dave Ramsey or somebody saying, yeah, just buy term insurance. Yeah, that's all you need to do, just buy term. Like, there's more to it that goes into that equation than just following things at face value. Like, you need to ask questions, talk to multiple. You probably need multiple advisors, right? Because one of your advisors is probably going to specialize in stocks, bonds, and mutual funds, and somebody else might be really good at all types of life insurance, estate planning, annuities. That's going to be different from the stocks and bonds and analyzing mutual funds and all that stuff. So you want multiple advisors, multiple opinions.
Yeah, I mean, that's really good advice, because I think people sometimes will instinctively think that, okay, I'm going to a financial advisor and they're going to, educate me and give me options for all of these different alternatives. And you hope that that's true. The fact of the matter is there's some of them that are compensated based upon the assets that they have under management with them. And so we even see this with reverse mortgages, for example. Reverse mortgages kind of got out wrapped from how they were structured years and years ago. When we go to talk to a financial advisor about it, it's starting to change now. But some of them are like, well, if I'm doing my job, then they don't need a reverse mortgage. Well, you're missing out on opportunities that the reverse mortgage provides, because it actually does some similar things to the whole life policy. Like you're saying, is you actually get to borrow against it and not pay taxes on the amount that you borrow. It allows you to access some of the equity in your home, because we've been cultured so much to pay down your house, owe nothing on your house, get rid of that debt. Again, okay, you got a 3% rate or a 4% rate. Oh, let's pay that down, pay that off. Like, no, but you got a credit card at 18%.
Yeah.
Let's pay that 18% down first, then worry about paying your mortgage down. But if you don't involve multiple different specialties of advisors in your planning, then you might get a skewed view of the world, because that's what they serve, that's what they've studied, or that's what they get compensated on. Whereas they don't get compensated on a whole life policy, or they don't get compensated on a reverse mortgage or whatever. So they leave that out of the discussion. So you have to bring a lot of different people in to properly plan, right?
100%. Yeah, there's definitely a lot of bias out there, right? Like, if you're talking to an advisor that all they do is manage stocks and bonds, and then anything you say beyond that, reverse mortgage, 1031, anything. It's if it doesn't fit their system, they're gonna argue against it. They're gonna say you don't need to do that. So yeah, it's nearly impossible to have one advisor for everything. They're not gonna know everything. It's the same thing like, you could be the best real estate attorney in the country where all you do is handle mega real estate transactions. You're really good at that, but you're not going to know criminal law. You're not going to know divorce. You're not going to know, it's going to be beyond your scope. It's going to be too far beyond your scope. So you need other advisors. And the same is true in financial planning.
Yep. Yeah, for sure. And I think, if people are kind of getting their eyes opened up by this conversation and they want to reach out to you and get some more information from you and get some advice from you that maybe they're not getting from their accountant or their financial advisor, what's the best way to reach out to you?
Yeah, easiest way, go to thinkinglikeabank.com. That's thinkinglikeabank.com. You can schedule a free 15-minute call with me. I'll send you a free copy of the book, Bank on Yourself Revolution. If you reach out, schedule a free 15-minute call, go to thinkinglikeabank.com.
Awesome. Well, I appreciate you taking the time to help educate us today.
Thank you. Thanks for having me on.
And everybody, appreciate you guys spending the time with us today. Again, tune in next week for the next episode of the Uncensored Real Estate Podcast, and we will look forward to seeing you guys then. Have a fantastic day.
Thanks for joining us, and please remember to go and subscribe, like, share, all that cool stuff to help us grow, and come back to listen to our next episode. Until then, go out and live life uncensored.
Thanks for listening to the Uncensored Real Estate Podcast. Don't forget to help us out and subscribe. Follow and give us a 5-star rating on your favorite podcast platform. And check us out on YouTube for the full video podcast. If you want more information on any of the topics discussed on today's episode, email us at uncensoredrealestatepodcast@gmail.com or give the Cardenas Mortgage Team a call at 480-331-4684.